Welcome back to the Future Show with Ben Lichtenstein. Traders, we just had non-farm payrolls come in at 145,000, a little bit below the estimate. For the most part, we're seeing kind of muted reaction in the indices, still holding on to positive territory, but holding below that overnight high of 32.87. There you can see the 1 minute time frame. You can see the net change currently up on the day by about 0.25%. Traders, take a look at the bonds, take a look at the 10-year, the initial reaction, a bit of a bid coming into play. You can see them here side by side. And in terms of market reaction too, take a look at the US dollar. It's coming off a bit. Gold's back up into that, well, 1555 area, slightly higher. I want to head on over to the floor of the CME group after we take a look real quick at the non-farm payrolls coming in at 145,000, below the estimate 158 we were seeing, and well below, well, it looks like last month's 266 got revised down to 256. The unemployment rate in line with expectations at 3.5, payrolls at 139,000. And take a look at manufacturing payrolls declining by 12,000, participation rate sideways, flat at 63.2%. Average hourly earnings slipped a bit, and, well, you can see the year over year, a bit of a decline. Traders, now let's head on over to the floor of the CME group. We have Alan Nuckman. He's the Chief Market Strategist at Agora Financial. He's standing by to help us break it down and take a look at some of the numbers. Alan, your initial thoughts? Looks to me like, well, one of the more closely watched components, the wages component, came in a little bit soft. So did the jobs number.
Right. Yeah, a little weakness there, but what that does set up for, I was looking at the Fed Watch numbers. There was a chance, there's a 25% chance that there could be a rate cut by July and a 50% chance by December. So that can maybe increase those odds. I haven't looked at the current odds, but that's now a larger possibility with a little weakness in the jobs, and like you said, some of the revisions. So it wasn't a big surprise, but what's not a surprise is new all-time highs in stocks. The market melt-up continues, and the stock market doesn't really care. Yeah, no, it sure doesn't. And it sounds to me, Alan, like you're saying this weaker than expected number kind of shifts those whispers of a potential rate hike into more like mumbles or murmurs, potentially of rate hike. I meant to say a rate cut. Potentially murmurs or at the very least mumblings of a rate cut to come. Right, and obviously that's one of the levers of stimulus that we have. It's kind of been exhausted, but it's still possible to continue to drive rates down. They did talk honestly about negative rates. I don't see that happening here in the near term. But looking at interest rates, it's interesting to see this 175 pivot level when you look at the 10-year. We've head firmed up, and the action this week is amazing. The fact that what we've gone through, and we had treasuries shoot up but give up all those gains by the next morning, and it's just everything's back to normal. Now the question is that the end of the volatility, or is that just the end of the beginning of the volatility? We'll have to wait and see, but I don't think everything's over. I think there'll be more volatility, but that's great. That's great as a trader. Yeah. I want markets to move, and we had plenty of movement this week. Yeah, you're not alone in terms of enjoying the volatility. Alan, I want to talk about how Morgan Stanley's chief U.S. economist, Ellen Zentner, she actually wrote the declines in the unemployment components in both the ISM manufacturing and the non-manufacturing surveys. I guess considering some of those declines we saw, I mean, this number soft could have been expected, but in all fairness, as you mentioned, this is still a pretty good number across the board. I was actually talking earlier with Andrew Thrasher about how it seems like this year or last year, one thing that was characteristically followed up by a sharp increase along the jobs number, along the lines of what we saw last month at 266, that got revised down to 256, but those were traditionally followed up by sharp declines to where we were seeing 20,000, I think it was in March, and then back in May or June, something like 70 or 75,000. But again, these numbers continue to point to exactly what we need to see and what the Fed wants to see to continue this Goldilocks scenario, a very strong, tight labor market. The pillar of strength continues to hold us up. Yeah, but it's also the prism you look at this through. Let's just go 4 years ago, and under a different administration, if we weren't getting 200,000 jobs a month, that was a disappointment to some. So now it's a different way to look at it, but it's the trend that's continued. How many straight months of job growth have we seen? I think it got up to 90 some at one time, and it continues to see this growth. Now, again, we all know the question about the labor tightness. How is that eventually going to spill into wages? We've been talking about that for a long time. It's more of a trickle down, and we haven't seen that yet. So I think the Fed can continue to do what it wants to do.
Well, speaking of trickle down, let's dive into that component, the wages component, because while annual wage growth is at 3.1%, you can see average hourly earnings year over year now coming in well below that at 2.9%. You can also see the average hourly earnings on a month-to-month, Alan, at 0.1%. Now, with the participation rate flat at 63.2%, again, this continues to be a bit of a head scratcher, Alan. The fact that we haven't seen wages, now we're at a point where we're hearing from the Fed where they're going to be willing to consider to let them run a little bit hot if that's the case here. But what can they do to stimulate that? I mean, is there anything within their realm of capabilities? I would think at some point they probably would have reached into the bag and pulled that out already.
Yeah, I have no idea how they can, light that spark, but that's what they're going to need. We've been trying to find that inflation spark as well, and obviously the higher wages could help that inflation spark. But you're fighting, the overall global pressures, downward pressures of deflationary environment. So it's a tough trick, but I think the next trick is going to be the dollar. We saw the dollar get down to 96, got down to 5-month lows, and then bounce once again. Let's see if it can make another attempt on that 96 on the downside, and that could be stimulative, have a stimulative effect here in the United States, which is essentially what they're looking for. They don't care how they get it. They're just looking to put a floor under this market and keep it going.
Yeah, Alan, you were talking about the strength in the stock market. When I look at this wages component and see the number coming in a little bit soft, I got to start to think about how this in many ways supports what we've been seeing here in terms of the stock market, in terms of low rates, because as long as that wage component continues to remain or fall below the Fed's targeted level, as long as CPI, PPI, and some of the core numbers that we look at continue to fall short, I mean, in theory, rates are going to continue to remain low. We're going to continue to see that fuel the market higher. In theory, wash, rinse, repeat, seems to be the case until we get something that comes in significantly higher and cause for concern.
Right. It's very simple. Where's money going to go?
Yeah.
It's not going to go into treasuries
until something negative changes. Rates.
Right. Until something changes, that's where the money flow goes. And, there's going to be opportunities. Obviously, this is a pretty extended move. The S&P's gone up more than 10% since that October breakout. And there's still more upside left. We saw a full V recovery, and I know you and I have talked about this before, a full V recovery in the NASDAQ, whereas the sell-off that we had in 2018, in December of 2018, the distance of that drop added on that old high, that's already been achieved in the NASDAQ. It hasn't happened yet. Is 3,500, which is still another 7% up above. So just because we've come a long ways doesn't mean we can't go further. But like you said, until the environment changes, money's going to flow into stocks. Now the question is which stocks, and if you look at some of the moves that we've seen here recently, it's getting pretty extended. So there's some danger there, as always. But that makes it more difficult to be a stock picker, obviously, at these levels.
Well, you know me now, Alan, I like the danger. Traders, that's Alan Nuckman. He's the Chief Market Strategist at Agora Financial. Really appreciate you joining us. A great breakdown, Alan, in terms of a look at the employment numbers and market reaction too. Now let's shift our attention on over to the Treasuries. I want to take a look at the ZB, the bonds. This